Yeah, I'm losing my
Quick beginner's guide to day trading, Mikey. This is going to be a good one here. We cover standard deviations and day trading a lot recently, but that's because a lot of the people have been responding to it. It's very similar to options traders out there who start to feel comfortable with, like, okay, that's a strangle, that's an iron condor. If I'm selling these options, I'm looking for this. If I'm buying them, I'm looking for this. And then they set up their mechanics for when I should be selling, when I should be buying, where should I be managing these things if I did sell options or buy options. Futures is a little bit more of a Wild West right now in terms of education and strategy. And you and I, not to toot our own horns, but here at the small exchange, we have been a little bit at the forefront at just fully fleshing out some of these ideas, because futures afford people so many different opportunities, especially day trading. And you've really put the pedal to the metal on getting out more day trading content to people in our social media and email feeds. So good on you, man.
Thanks so much. Yeah, it's been pretty cool. And this is something that was relatively new for me. I started my trading quote unquote career with option strategies, buying and selling and all of these kind of complex, multi-leg strangles and stuff like that. And I kind of shied away from futures because I didn't have a solid foundation or understand the mechanics for how to trade futures. But really, when you pop the hood and look at what the contracts are and what they afford you, it's a really nice strategic trading vehicle. You have extremely low margins on futures. You have no pattern day trading rules. They're fast. They're just set up for day trading. And finally, from you, I learned a lot of these mechanics, and we've been trying to share a little bit of our learnings with all the folks out there.
So let's get right into it then, Mikey. I couldn't say any of that stuff better, advocating for the pros of trading futures, or at least adding it to your trading toolbox here. Now, to kick things off, and I know a lot of viewers out there have already heard this stuff, but I've got to reiterate it because it is so important. The standard deviation is so essential to day trading and futures trading in general. It quite literally is the implied volatility of options trading. It dictates where I get into a position. It dictates where I get out of a position. It dictates how much I'm looking to make or lose on any of these positions. It's quite essential here, and we're going to get into all those details in a second, but I just want to show people, like Mikey said, I'm going to borrow this idiom from you, pop the hood on where these numbers come from and then what they mean. Because you see here, this is a bell curve, and it's showing you a distribution of, in this example, essentially a distribution of net changes for the product that we're looking at here today, one of the smallest products from the small exchange, the small 2-year yield futures, which is the 2-year treasury yield futures. And if you've been reading the news or anything like that, they've been moving around a lot. Now, Mikey, this bell curve with those 3 different regions tell you 1 standard deviation, 2 standard deviations, and 3 standard deviations. And you can see that 1, 2, and 3 standard deviations are just multiples of that first one. And that first one tells you, okay, 68% of the time, this market stays in this range. 95% of the time, it stays in this wider range. And then almost 100% of the time, it stays in this widest range. And that's going to be extremely useful for our trading. But first, let's pop the hood and see where we get these numbers from. You've been crunching a lot of these numbers. Why don't you tell the people what we're looking at here in S2Y?
This is beautiful. I love that we're digging into the actual numbers here. So the standard deviation is just a tool to describe a set of data. And here we're looking at that set of data. It is the daily change in the futures price. We wrap a standard deviation around that to say, okay, on average, how much variation is there in this data? If the data we're looking at is daily change, we can say, okay, on a normal day, the deviation from day to day in 2-year futures is X or Y, whatever it is. So it helps us establish a range on how much the underlying future can move. So yeah, we're just looking at a historical piece of daily change in a future and then wrapping a standard deviation around it to describe that movement.
And I don't want people to have to be at home crunching these numbers for themselves, but I do get these questions quite often, which is, how are you getting this standard deviation number? And these numbers are output to our community members for, life for as long as this exchange is around here. Every Monday, we refresh these numbers and send them out. community.thesmallexchange.com if you want those numbers and reduced fees for life. But I did want to show people where we're getting this stuff from. We look at the last 3 months of data. Those are in that first column there, Mikey. Those are just the closing values of S2Y. And then in that column next to it, all I do is in that first piece, I take day 2 minus day 1, and then I take day 3 minus day 2, 4 minus 3, 5 minus 4, and so on until I have a column of data there for the last 3 months of daily net changes. And then all you do, if you're in Excel or wherever else, is you run a standard deviation function of that column, and it's going to spit out exactly what you said there, a number that says with a fair amount of confidence, 68% of confidence, your data set here lived inside this range. And in this example, the number it spit out was 37 cents. And you can kind of see here in this example, there are some days, where the market was up 68 cents. It was up 72, 76 cents a couple of days. It's down 39 cents in that last data point there. It gets outside of that range, but 68% of these data points, and this is only a handful of the 3 months that we look at, 68% of these data points will be inside that 37 cent number. Now, how do we use this? Well, to kick off, a standard deviation and relating it to where the market is currently just gives you essentially a signal that's like, oh, abnormal activity is going on. The market's outside of the norm. That term, we use that term a lot, outside. Right, Mikey? And what does that mean here in this example? And just for day traders, when you're talking about net changes versus that standard deviation, what if I told you, oh, that market's outside and thus I'm looking at selling it? What are we looking at here in S2I?
Sure. So we can see, the market opened, around 9 a.m., 8:30 here Central Time, around 10:15, and it just traded higher, rallied all the way up to 10:50. That movement from 10:15 to 10:50 is more than the one standard deviation move. It's more than those 30 cents that we just identified on our previous slide. So we'd say this is overextended. It's moved beyond what's kind of normal for this product. If we know on a day-to-day basis, the change is around 30 cents, and today it's up 40, that's an indication that, hey, maybe this thing is going to come back. Maybe it's going to finish within that 30-cent range, as 68% of the time, that's what it does. So you kind of use it as a trigger or an alert to say a market is moving beyond what's normal for it, and there's a potential either reversion trade or a trend following trade there.
Yeah, and we err on the side of a reversion trade, especially when you're talking about day trading opportunities here a lot of the time. I simply look at it as like, oh, the market's outside. Well, I have a 68% shot that it's going to settle the day inside. And so I'll get on the other side of those odds. And you don't even have to, that theoretically means, oh, okay, I'll sell it if it's up a standard deviation or buy it when it's down. I'm not going to actually hold it to the close, hence the day trading. You see that when a market gets outside of that range, that is a signal both for contrarians and trend followers that opportunity is afoot. And then from there, you can manage that intraday. It's very similar to implied volatility and IV rank, where that number just kind of, as you're perusing different markets, it's like, oh, that one has no opportunity, no opportunity, no opportunity. Oh, the IV rank on that market is at 60%. There's opportunity in there. Same with, I'm just monitoring net changes of all of these small exchange markets. And in my head, I'm keeping that reference point of what the standard deviation is. And so it's like, oh, inside, inside, inside. Oh, that one's outside. I'm going to look to trade it. And in this example, you have the market outside its standard deviation. And then by the end of the day, it had come back within that one standard deviation move. And you've been great about putting this graphic together, Mikey, and then also sending it out for free when we see some of these moves outside on the Small Exchange Twitter, which people can go follow and get some of this information as markets move to the upside through their standard deviation, and then could come down in accordance with those odds at some point during the day, or through the downside. It's funny enough, today S2I moved below its one standard deviation and actually has popped back now in recent trades. So both directions. And why don't you tell people a little bit about this graphic and how they can find it at the Small Exchange Twitter.
Yeah, so we try to be pretty active on Twitter in letting you guys know what's going on in the market. We don't only put out exchange updates like options are coming January 25th, but we also try and identify interesting moves in our small exchange market. So every few hours, we'll run a scan and just see kind of where things are relative to their 3-month standard deviation. Here you can see an example with 2 years. We plot the net change, which is going to be yesterday's close. So you know, as a reference, if this market is higher or lower than yesterday. And then we also draw a horizontal line for either that upper standard deviation or that lower standard deviation and what that amount is. So in this example, we're looking at an upper standard deviation, 2 years trading above or outside of what a normal range is. And we might expect this to come back. Now, it doesn't happen every time, of course. We know historically 68% of the time tends to come back after these moves. But just wanted to put this in front of you guys almost as like maybe an alert. Maybe you have a position in 2 years, or maybe you don't, and you're looking for something that's moving around. Hopefully this gets in front of you and you find it interesting, and you can maybe make an opportunity out of it.
And the last point here on day trading, you've got, what a lot of people are looking at to get into positions. But when that market pulls back into that 1 standard deviation range, that's when people are getting out of their positions there. Or by the end of the day, you'll see me a lot of times when the markets are going to close around 3 or 4 p.m. Central time. I'll just get out of those positions for a slight winner or a slight loser because it hasn't hit my target. But the idea usually goes, okay, if the standard deviation is 30, 40 cents, the market is up 40 cents, I sell it. I'm usually just looking for it to come back probably half as much, so 20 cents, and then I'll take that off. And if it climbs 20 cents against me, I'll take it off for a loser. And that's hopefully A to Z on day trading for all of you out there. Well, thanks so much, Mikey, for joining us here on the program. It's always a blast.